Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron, our midday interview at the Canadian Apartment Investment Conference, part of the video speaker series, sponsored kindly by KingSet. We thank them for that. Today we have a returning guest. We've interviewed him.
It's my third or fourth time.
Yeah.
And your partner, twice.
Yeah. Out in his neck of the woods, being Vancouver, and then here as well. So returning guest, Mark Goodman, Goodman Commercial.
Great. Well, thanks, guys.
Are you guys the largest broker in BC?
We're a small firm, but we got a big punch.
Okay.
We generally have roughly 20% of the market.
It's huge.
Yeah.
For independent. I guess your competitors are the CBREs of the world, right?
I've heard of them before.
Yeah. Okay.
Yeah.
It's tough. It's tough. I mean, we know, our competitors are Royal Bank of Canada, right?
Sure.
It's
Sure.
At times it's complicated.
Why are we advertising our competitors
All right,
here?
yeah.
This is Who else is great at the business other than you, Mark? So we won't
I didn't say great. I just said who else does it.
We won't do too much of the background, but I guess the quick and dirty is Mark is a very prolific broker, multi-generational, Vancouver laser focus. Right, you don't stray too much. Metro Vancouver. So he could probably, for a $10 Uber, get to his entire territory of sales. But there's a lot of apartments packed in that area, so it works well for him, I'm sure. So today we're going to get into discussion. I mean, Vancouver is an interesting market. I spent some time there. I quite like that market. It always seems to act independently of the rest of the country. It was the first one to experience the hyper compressed cap rates. The first one to experience the hyper compressed occupancy rates. The rest of the country now, of course, has caught up. But we're going to do a bit of a deep dive in the last, we're talking about 2 years, I guess, in the Vancouver market.
2.5 years.
2.5?
So yeah.
Yeah, and this is the guy to talk to about it. So to jump into it, I guess we'll do the short history lesson. Kind of go back. What was going on 2.5 years ago in the market?
Why
where are we now?
Why don't we start just post COVID and just kind of walk our way through to today?
Yeah, do it. Let's start with where we were, and then that'll lead to where
It's
we're
been a bit of a roller
Well, when did
coaster.
Vancouver declare post-COVID? It felt like it was way sooner than Toronto. We were all locked up and hearing about you guys, walking through your malls and meeting in restaurants. So when was post-COVID in Vancouver?
Well, I mean, the market shift probably a few months after the lockdown. Was the lockdown March 2020?
Yeah.
Give or take. Toronto was a couple weeks ahead. I was actually visiting a few clients in Toronto in March, a few weeks before the lockdown happened. And it was interesting because this thing called social distancing was happening in Toronto. We didn't see it in Vancouver until 2 or 3 weeks after. But I was meeting with some clients here, and some they wouldn't shake my hand, but we could sit face to face. We didn't know how it was transmitted, and then other clients it didn't matter, and then you guys had your lockdown, I think, before us, but that was an interesting time. So as we all know,
I'm getting PTSD just thinking
my God.
about it. Yeah.
Well, Aaron had version 1 COVID and got.
I got all three. No, I was collecting the bingo cards for it. Anyway, let's not do that. Let's not go there. Apartment market in Vancouver.
Yeah.
Then versus now.
Yeah, so we were deemed an essential service as a real estate company. So I came into the office every day, which was a godsend, and all my staff were working remotely. And for 2 years, I was essentially hunkered down, Zooming and doing deals. And we went, in 2021, we did over $500 million in sales, 39 transactions, of which 23 were unconditional. So it was a turbocharged time. We were selling properties every couple weeks. We would prepare our purchase and sale agreements in advance, templated, unconditional offer, conditional offer, and we'd press send on our email blast, and we'd sell property, unconditionally for the most part. It was a crazy time. And then, as we all know, when we moved into 2022, what was Bank of Canada? It was like 0.25, I think, in early 2022.
You got all the way down to 0.37 or something like that. But insane.
It was insane. Free money. And that was fueling the market. And then something happened. We started going up, and I noticed a shift in the market, but we couldn't quite put our finger on it, how bad it was going to be. And as we all know, by the time we got to mid-2023, we were at 5% overnight rate, and the market was basically frozen. We couldn't sell anything. And now we're seeing a little bit of relief. Once that rate rate held for the few consecutive announcements, we started to see the market moving a little bit, and that optimism has carried on to 2024. So things are looking much better now. I've got 12 proposals on the go right now. We've done $145 million in sales in the first 6 months, 11 transactions. And if we look at the first 6 months of this year, dollar volume has increased 69%. Transactions have increased 59% for the same period last year. So there's certainly a lot more deal velocity. But just to get an idea of how pronounced the shift in activity was, from 2021 to 2023, we had a 62% drop in dollar volume. So we went from $2.6 billion in 2021 to $1 billion in 2023. And it really shook the market. And I think 2025 we're going to be back to whatever normal is, but we're going to be able to put deals together because the delta between the bid-ask spread right now is still pronounced, but it's shrinking.
I've said it before. One of the just the cute conversations. Actually, it was Sarunas, Michael Sarunas, who was just on the panel moderating your last panel. He was talking to our team about just where the market is and what his brain's doing at Hazelview, and he goes, "I'm a buyer at 4.5, and I'm a seller at 4."
Yeah.
Of cap rates, right? And he's just that was the bid ask issue, right? It's like I won't sell anything for more than a 4 cap, but I won't buy anything for less than a 4. And that's why there was no transactions occurring, right?
And a half-point spread on a large building is quite significant.
Yeah, well, exactly. That's will make or break the sale, right?
Right.
And nothing. And to be fair, I'm not sure there's a ton of momentum yet. I mean, you said you're feeling it. You're on the front line.
Oh, yeah.
Are there a lot of tires being kicked? Like, is that bid-ask spread coming down? For context, it's early September. Government of Canada bond is 2.8 something or other, down from 4 early June. Mm-hmm. So over the course of 3 months, June, July, and August, we've come down 80-something basis points. Mm-hmm. So presumably that means that 50 basis point cap rate spread is evaporating.
It's a little too early to tell. I think once the dust settles, another 6 months, we'll be able to look back because there's this lag time. But, last year, some of our deals that were being underwritten, the loan to value was like 30%. You had to put down 70% just to get a loan. Obviously, stuff wasn't trading.
That's a deal killer right there.
Can you believe that?
Yeah.
There's certainly more optimism. And I can just tell you, like, qualitatively, there's more calls coming in. People want to list their properties. I think there's a lot of psychological momentum now that we've had another 1/4 point decrease. So we've had 3 consecutive decreases. We're at 4.25 today. Is that right?
Yeah. 6.45 is prime. That's the way I kind of think about it. Which, I mean, to be fair, taking a land loan, it's still prime plus 2.5. It's still a 9% land loan, which is not cheap money.
No.
What's the buyer profile look like right now? I mean, I think that's evolved over time, right?
Yeah.
Let me just talk about what you're seeing there.
Well, traditionally, over the last few years, we've been predominantly made up of private buyers. 85% of the market has been private. About 10% has been institutional, so REITs and pension funds. And 5% generally was government nonprofit. And that trend has been around for several years. In the first 6 months of this year, things have shifted. So private buyers still dominate most of the market, but nonprofits have shown a tremendous increase in activity. So they've gone from 5% to 24% of all transactions in the first 6 months were nonprofits. And that made up 50% of the volume in the suburbs. And that change is due to the Rental Protection Fund, which is a provincial initiative that is offering grants and subsidies to nonprofits to buy older, affordable, and keep the rental buildings affordable, keep the rents low.
Soon to be a federal program.
Yeah, the Trudeau government is working on that. Katie Maslechko, thank you, was on the podcast, and we discussed at length the program and the funding and the growth and her efforts to really add some maturity. First National is at the front lines of this, just to be transparent. CMHC will finance a lot of those acquisitions, and we've been working with CMHC and BC Rental Protection Fund to figure out how all the agreements and the forgivableness of the loans, etc., work together. But it can be a really great program.
Yeah, I mean, especially in a down market when we didn't have a lot of activity from private buyers. As a broker representing sellers, we were quite happy to have buyers using the nonprofit fund. We actually sold a building in Burnaby about 6 months ago to a nonprofit that utilized the rental protection fund, and it went relatively smoothly. I thought there was going to be a lot of bureaucratic hoops to jump through and extraordinarily long timelines, but I mean, it was a little longer than you'd normally see from a private investor, but it was relatively smooth, so it worked out.
There's a motivation to get housing, to help support housing at all levels of government.
Yeah,
I know. Well, Katie was on. Like she was saying, there were some challenges with one of the wrinkles in one of the agreements for one of the transactions. I'm not sure if it was yours, Mark, or not, but she kind of matter of fact said, I just had to pick up the phone and call and go, come on, like let's just, what are you doing? Let's just do this.
The same vision.
Like you're going to cost a whole bunch of issues if we can't just get this done. And
well, remember, I've worked with a lot of nonprofits over the years that have acquired buildings just the old-fashioned way, and each nonprofit has its own systems. I've had to counsel a lot of nonprofits and said, listen, you can't have 25 board members go through the building. You need to create an acquisition group of 2 to 3 people. You'll have your 1 or 2 board meetings where you'll set the stage, but you have to let them negotiate and you have to empower them to do the deal. Otherwise, it's going to take forever. And so there was this educational process that we would go through, and we've acted for nonprofits. We sold a property for a nonprofit that did not utilize the rental protection fund about 6 months ago, and I helped them create the committee and work through the process. But one of the challenges right now is they've been allocated about $500 million. I think they've spent probably half of that. I'm not sure. Katie,
well, it's Vancouver. It's going to go quick.
It goes quick. But I mean, you have to wonder: is this really the best use of taxpayers' dollars? And we're not creating any new rental stock. Essentially, what's happening is that we're freezing these old rental buildings and we're removing them from the public domain. And you're just shifting it from one group to another, and you're keeping these rents low. The challenges that we're going to have is what happens when the boiler needs to be replaced and the roof needs to be replaced, or a lot of these nonprofits are carrying debt, and if they're keeping the rents low, they're not keeping up. What's going to happen when their mortgage matures? How are they going to service the debt? And so this has been a point of criticism from many people in the industry. Is this really the best use of funds? Of course, I mean, if you're a tenant and you're being protected, that's fantastic. There's about 1,500 tenants right now that are going to be protected. But one could argue that this is going to make rents more expensive for everybody else because it hasn't created any new housing. And, the other interesting thing about the Rental Protection Fund is that this is a provincial mandate to preserve and protect and freeze apartment buildings from being redeveloped. But at the same time, you have another provincial legislation that was passed, which is the TOA, the Transit-Oriented Area Development legislation, which is basically the province is forcing the hand of the municipalities to build. And they can't cancel or restrict projects based on density or height. So, a lot of these areas near transit nodes have been slated for redevelopment, 20, 25 stories, 6.5 FSR. And then the Rental Protection Fund, in some cases, is acquiring buildings in those neighborhoods. And so...
also freezing the air rights, essentially.
Well, it's freezing everything. And they purchased a property in Coquitlam that was ripe for redevelopment. And, we could have had hundreds of additional units built there in a prime, high-density area. And so, you have a low-density apartment building that's, it's great. It's protecting those tenants, but at what cost? So that's been...
it's a complicated issue.
It's complicated.
I was just thinking to myself, I'd love to have Katie here to hear what her rebuttal is, because I'm sure she's got one. And I'm not to say it's just I subscribe to either
camp.
Yeah, exactly. Other than it's really complicated, because you're absolutely right. Like, probably best use of that land is somewhere that we can add way more units, but those units would be rented at much higher levels, and so then you could say, well, don't buy those buildings in those high density areas, but then they're not close to transit oriented areas.
Well, that's right.
And people that can only afford more inexpensive rent deserve to be close to transit also. So like there's this whole like snowball discussion, right?
And I know some of the tenants in these buildings, and a lot of them don't need affordable rents. A lot of them are making
that's a different conversation.
They'll just take it.
They're making $100,000 plus a year, and
it's like the banker that
they won the lottery.
The banker that lives in a co-op, right? Like it's
So I mean, is that really would a more targeted approach be better for people who actually need it? So you're freezing a building, and remember, these nonprofits are buying buildings. Majority of them are full, so they're waiting for natural turnover to put one of their members in, and those tenants living in there, as I said, many of them are professionals making good wages. They've just won the lottery.
I heard it at one of these conferences years ago. Now we're getting off topic, but we'll keep going. A solution. I don't know if it's the solution. I'm sure there's good reasons why it wouldn't work, but you give affordability cards or licenses.
Means tested direct to the tenant.
Right. And they can go and rent a basement apartment, or they can go and rent a penthouse, I guess, if it qualifies or whatever. And the subsidy just comes to cover the difference, right, to the landlord or to the property owner. And that tenant therefore can live anywhere. And it totally changes this discussion, right? All of a sudden, versus having right now they're building buildings and they're putting in a floor of affordability, or they're making these sections, right? And we're all trying to figure out how to deal with it. If it's just geared towards the income of the individual, they can go rent anywhere. Seems like the solution. I'm sure there's lots of
free market.
Yeah, I'm sure there's lots of reasons why it doesn't work, or maybe it's just more expensive and the governments don't want to pay for it. But
the other frustrating thing is the premise and the narrative of the reason why we need to spend $500 million to preserve affordable housing and the narrative is that we have to protect this housing from speculators, international buyers, and the corporations. So there's this old tired narrative of the vilification of housing providers.
Yeah, it's the financialization of housing argument. And I know it's got some news recently that
CBC just put out an article on that front. Yeah,
and I'd say the financialization of housing is what got stuff built in the 60s and 70s.
Well, most of our clients are making maybe 5-10% return on their investments. How much tax goes on those investments? The government's making way more money off of housing than any owner. Well, that's anyway. Let's just leave it there.
So you have to wonder with the narrative behind the strategy. The reality is that the institutions and the corporations are actually the best landlords. They're well capitalized. They have to play by the rules. They're accountable, and no one's getting kicked out on the street. But you still hear that narrative. Of course, they need to increase rents on turnover. But anyways, it's great. We're helping people. There's 1,500 tenants now that don't need to worry. However, some of them never had an issue to begin with.
They weren't worried anyway.
So
it's a piece of the solution. There's lots of pieces of the solution. Yeah.
Well, and the government subsidized buyers would also tend to push up values because it increases purchasing power.
That's right. Yeah, well, there's lots of It's really complicated.
Every lever you pull, 6 dials all start turning. It's a complicated world.
Okay, we're gonna play a game.
Okay. Poker or
no, I'd lose to you at that. Adam was a professional poker player, by the way, if you didn't know that. So First National did a study of our own loans, and we went back and we looked at all of these CMHC insured loans that we've done across the country, all sizes and scopes. So we're talking very, very national average for the last 11 years. So through the pandemic, all the way up until I think it was 2013 or 14 that we really kind of started. So there's the brand, there's the bucket of loans, and it was thousands of loans, right? We do 1,000 loans a year, so it was like 8,000 or 9,000 loans that we looked at. And what we did was we took the day that we locked the interest rate, we took the Government of Canada bond, and we took the cap rate that we were able to finance on. So this is the First National procured finance rate. We did a lot of purchases in there, so that would have been the purchase cap rate, and there's also the cap rate approved.
Is the lending cap rate or
this is again, we're talking average. So use that, take that as a grain of salt. But maybe it's not the market cap rate, but the market cap rate would have been infused in part of this. It might have been lending too. And we took the Government of Canada bond at the day that we locked the interest rate, and we had determined a spread, a historic national spread of cap rate over Government of Canada bond. What do you think that spread is?
110 beeps.
Okay.
Well, it depends what market you're talking
Well,
about.
no, the general national average.
Because Michael was on stage talking about Toronto, and the delta was much more pronounced in Vancouver.
No, fair.
Very interesting.
I knew, this is just
Goes
context.
against common sense.
This is context. That is 110. What do you think?
I don't know, 50 basis
11. Okay, 300.
Wow.
No kidding.
300. The
That's
average
across all
cap rate
markets in
across
Canada?
Canada with 11 years is 300 over Canada. So if the Government of Canada bond today is 2.9%, historically the average cap rate would be 6.9% across the
See the
country.
spread in there too. Yeah, I spent too much time in Toronto and Vancouver. I guess my expectations on yield are very thin. I suppose.
Well, and that obviously I'm not arguing that apartment cap rates across the country are 7%, but the point is context. So you were mentioning, and we're getting into valuations now here, obviously. You were mentioning, back when bond rates were 50 basis points, right, at the very bottom of all of this, and I'm sure everything was trading at a 2 and a 2.5 cap.
Yeah.
That was 150 to 200 basis point spread at the time. Now 2.5 cap seemed like incredibly low.
Yeah.
But it was still a 200 basis point spread over
But
Canada.
I'll tell you why. Because back in 2017-18, cap rates were not as important as they are today, and investors didn't put as much weight on that metric. And the reason is that a lot of these buildings were being purchased and renovated, and many of the buildings were emptied. There was a wholesale eviction, and they get their permits and they rehabilitate the building. And then the legislation changed in BC.
The unit rollover doesn't exist the way it used to. But back then, we were talking 20, 25%.
Right.
Some guys were projecting they could do 30, 35% with some cute approaches and things like that. No, and I trust. Cap rates are an awful tool, right? Like they really are. They're it's nonsense because it doesn't include liquidity, doesn't include rent growth, doesn't include all sorts of factors.
Mark-to-market.
Yeah, density on the site.
New build versus
no, and I get it. And so obviously, but again, the concept of you said 110, you said 50, it's 300. It's just putting into context where that stacks. And let me keep going. I've done this before on the podcast, but this is just fun to go down. You got to remember just that risk return yields, right? Like it's pretty basic sort of economics, right? So if Government of Canada bond free or risk-free return, 2.9%, right? And then you're buying a piece of real estate. So a piece of real estate should have a positive leverage over that.
Yes.
The interest rates that we're earning often have to trade below the cap rate. Interest, like just to earn a return, like Adam and I earn a return for First National, it's about 100 basis points over the risk-free rate, let's say, for CMHC insured, right? It's more like 200 for commercial. So 2.9% makes 3.9% for the mortgage loan. And then there's still another positive spread.
Investor return.
The investor return. And so maybe that's 50, maybe it's 250. Like the point is it's got to be something, right?
Who's giving up there, right? Who's like the bonds aren't moving.
Where I want to go, and I'm going to throw this back to you guys after this, is we had a long sort of bearish interest rate hiking environment, right? Where
the long dark winter.
Yeah, exactly. Yeah. Bonds went from 0.5, we were talking about, all the way up to 4 or so, and that was 350 basis point rise. Again, assuming these types of yields are kind of connected, in theory, cap rate should have risen by something close to that.
You would think so.
They didn't. Now all of a sudden bonds are down 80 basis points, and we're hearing, hey, cap rates are down 80 basis points. Like, wait a minute. They went up 300 and don't move.
Yeah.
Then they come down 80 and they go down 80. Like I think we're sometimes losing perspective here on how these things all have to relate to each other.
Yeah.
Well, and the lag in reporting and all that. I mean, I remember looking at one of those charts, the highlights we were talking about, and in 2020, I mean, bonds went to near zero, interest rates were sub 2%, and cap rates hadn't moved that much. So that part of the pie was super fat. The investor positive leverage was just enormous.
Well, you were doing 2.5 caps. It was still a 200 basis point spread, right? Like today, you're not, if at 2.9, you're not, rare 5%, particularly in the Vancouver market.
Yeah,
right?
but that was the counter argument, though. Because, you're trying to say it should be perfect symmetry, up and down on these cap rates. So cap rates moved downwards during COVID, but not that dramatically. So when interest rates started to go back up, the first however many beeps increase was just slack in the system, kind of getting back to normal, which is why you wouldn't expect it to move. But yeah, I get what you mean. That it should be almost synchronized movement between all of it, but. You're talking about cap rates that are
listen, cap rates are dumb. This is more of a theoretical kind of fun, tongue-in-cheek conversation,
well,
right?
Look, when CMHC 5-year money hit 5%, cap rates were at 6%. People just stopped selling.
Well, that
was it.
That was the bid-ask issue, right?
It's just not going to happen. And now that, what is 5-year money now? It's like under 4.
3.5.
3.5. Well, now things are starting to open up. It's starting to make sense. There's a lag time, and you made a good point. There's this lag time where it takes, you need to wait to see how the market's being moving. We don't have instant reporting, but qualitatively, like, we're getting a lot more interest in our product right now, and sellers are, I think there's been a psychological shift where they're seeing the light at the end of the tunnel. So,
what's interesting is that we always kind of get clarity 2 quarters after the fact, right?
Well,
those transactions are going to send it now.
Right.
So
yeah,
there's a good lesson in foreign investment in Achilles when they entered the Canadian market, but it was big time in the GTA at first. This was like 2014, 15, 16, when cap rates were still 5.5%, and that spread was still healthy between interest rate and cap rate. And Achilles came in and started buying everything at 4.5 cap. And everyone was going, "Oh my God, these guys are insane! Like it's dumb German money. They don't know what they're doing." And in hindsight, now 10 years later, they're brilliant, right?
Yeah.
They were buying at a great time. It was risk adjusted for them because they were taking geopolitical, perspective. We now are hearing whispers that the same kind of thing is starting to transpire. Do you have any sense into that?
Well, it's interesting. We don't have a lot of foreign buyers because they've restricted that for, I think, all residential. And then for multifamily, there's a significant foreign buyers tax. But I recently sold a building in Vancouver to a Singaporean billionaire. And he paid the foreign buyers tax. It was incredible. It was also a redevelopment opportunity. But you are right. Like, we're so insulated in Vancouver, we sometimes can't see the forest from the trees. But there's currency plays. There's the fact that we have a stable government. Our land title system isn't corrupt for the most part, based on my understanding.
That's what title insurance is for, isn't it? Anyway, keep going.
Yeah, so you make a good point where investors are coming in and they're looking at it through a different lens, and we're not seeing as much foreign investment as we did previously. But historically, the Vancouver market was actually never really had a lot of foreign buyers. We did a survey for the Globe and Mail years ago. We went back to our last 200 transactions. Only 2 were technically foreign buyers. One was from Austria, and the other was American. And foreign buyers were buying a lot of land, and they were buying luxury homes. But multifamily is still like it's a local type of business. You need to be hands-on and manage the property because we don't have a lot of institutional grade properties. But it is interesting to hear your points because those 2 investors that I dealt with were looking at the market through a totally different lens and how they analyze it. And one was using Swiss francs against our currency, and it made sense. And we sold an airspace parcel to a foreign buyer when they weren't quite popular here in Vancouver, and they said, "Oh, this is we're very comfortable with this type of."
I think we underestimate as a country and a society just how safe we appear.
Oh yeah.
In a turbulent global environment, right? With all the wars that are kind of transpiring and all the risk that's out there.
You're not coming here for yield. It's
it's safety, right? It's
for sure. It's not wealth creation.
It's preservation.
It's not wealth creation.
I think if you're a 30-year horizon, you might end up generating some wealth anyway, right? But it's just capital preservation, right? For a certain degree, and I think you lose track of that. So unfortunately, as geopolitical landscapes get more turbulent, it makes Canada more attractive to international capital.
For sure.
Particularly in the real estate space, where you can cut a check for $500 million, right? Not a lot, not often, but you can do it, right? So
maybe before we wrap up here, as we are kind of getting out of time, where are cap rates headed in the next 12 months then?
2.5.
This is
2.5,
really
okay.
good question. I think I actually, so here's my latest chart. We're going back to 2013, and if we take the average between the city and the suburbs, look at this. We were over in 2013 over 4, And today we are at a 3.8 cap. So we've gone up a little bit. Last year we were at 3.56. I see cap rates not moving down very much. I think a lot of the mortgage money's everything's been baked in now, and I don't see any material change in value over the next 12 months. I just think we're going to see a little bit more activity.
The reason cap rates are so dumb is because, as we all know, Vancouver with land constraints and all the other things that go on, that plays a big part. In my opinion, humble opinion, if you can finance at 3.5, 3.25, and buy it 3.75, that's a great deal, right?
Yeah.
For a Vancouver asset.
As long as you're not putting 70% down.
No, I know, but you wouldn't be, right? I mean, presumably rents are up there, and so that covers.
You're about 50%.
Yeah, 50 to 60%. I think loan to value is reasonable for what you guys have been dealing with historically, right?
Sure. I remember you could put down 25%. You're getting a 6.5 cap.
And valuations were probably $300 a door, not $600 a door.
Or $100 a door.
So
even,
when I started 23 years ago, prime West Side real estate per door was trading at $80,000 a unit. Expense ratios, which we used back then, were 33%, and rents were $750 a month for a one-bedroom, and that was back in 2003.
The simpler times.
Yeah. And there was no highest and best use analysis. There was no land use policy changes. What you saw is what you got.
Still use gross income multiplier, probably.
Oh, I love GIM. I love GIM. It was great.
Only to have a time machine and that $500 million we were talking about.
If I only knew.
Right? If you only knew. Mark, thanks very much for coming on. Always a pleasure. Really like chatting with you. Thanks for your perspectives. Thanks for listening or being patient with my ramblings.
I love your rambling.
You and no one else, I think. Even Adam's giving me the eye, like he's just rolling his eyes at me. Thanks to KingSett for sponsoring the speaker series here at the Canadian Investment Apartment Conference. Thanks to First National for powering. And again, Mark, thanks for coming on.
Thank you very much.